Are you unknowingly sabotaging your financial future? What if I told you that there are 3 wealth killers draining your hard-earned money every single day? And most of us don't even realize it? But here's the good news. By the end of this video, you'll not only learn how to identify them, but also how to defeat them like a pro. Stick around to hear real-life stories from Singapore and the US about people who turned their financial setbacks into major comebacks. Plus, if you're serious about building wealth, make sure to hit the like button, subscribe to Wealth for You, and join our growing community of future millionaires. Ready? Let's go! Wealth Killer 1. Spending beyond one's means on property. Owning a home is often seen as a milestone of success, but buying a property that stretches your finances too thin can be a significant wealth killer. Many people fall into the trap of over-leveraging, focusing on the size or prestige of their property rather than what they can comfortably afford. The problem: a larger, more expensive home comes with hidden costs. Higher down payments, mortgage payments, property taxes, insurance, maintenance, and utility bills. Stretching beyond your means to own a dream home often results in being house-rich but cash-poor, leaving little room for savings, investments, or even day-to-day living expenses. How to overcome this wealth killer? 1. Calculate the true cost. Don't just look at the purchase price. Factor in all the ongoing costs like maintenance, taxes, and insurance. Use the 28-36 rule. Your mortgage payment should not exceed 28% of your gross income, and total debt payments should not exceed 36%. 2. Prioritize affordability over prestige. Instead of chasing your dream property immediately, focus on one that fits your current financial situation. A smaller home or a property further from city centers might free up funds for investments that can grow your wealth over time. 3. Build a cash flow buffer. Before buying, ensure you have an emergency fund that covers at least 6 months of expenses. This will act as a cushion in case of unexpected financial challenges like job loss or medical emergencies. 4. Invest in income-generating assets. First, consider starting with investments like REITs or dividend stocks before committing to an expensive property. These income-generating assets can help supplement your mortgage payments and build wealth alongside home ownership. Real-life U.S. story. Mark and Emily's adjustment. Mark and Emily, a couple from Florida, wanted a big house with a pool in a trendy neighborhood. They stretched their budget to buy it, leaving them with high monthly payments and little left for emergencies or savings. When Mark's job became uncertain, the couple realized their precarious financial situation. They sold their home and downsized to a smaller property in a less expensive area. The lower payments gave them breathing room to save and invest. Within 5 years, they built a diversified portfolio of dividend stocks and REITs, using the cash flow to eventually upgrade to their dream home. This time, with no financial stress. Are you currently saving for your dream home? Have you calculated how much house you can truly afford? Let us know in the comments. Wealth Killer 2. Buying a luxurious car before assets. It's easy to get caught up in the excitement of owning that dream car. After all, who doesn't want to cruise around in a sleek, shiny new vehicle? But here's a hard truth. Buying a luxurious car without first building a solid financial foundation can set you back in ways you might not expect. While a luxurious car might turn heads, it doesn't turn a profit or help you build wealth. The problem. Luxurious car can seem like the ultimate reward for all your hard work, but these purchases often drain your resources rather than generate income. The monthly payments, high insurance costs, fuel and maintenance bills add up quickly. Worse yet, cars depreciate the moment you drive them off the lot, making them a liability rather than an asset. And if you're financing your car, you're adding interest payments to the mix, turning what could be a symbol of success into a financial burden. But here's the real kicker. By focusing on building assets first, you can eventually afford the luxury car and have your wealth growing in the background. How to overcome this wealth killer? Adopt the rule of 5. If you can't buy 5 of something without going broke, you can't afford one. This simple but powerful rule shifts your mindset from instant gratification to mindful spending. If that luxurious car is out of reach for 5 purchases, it's a sign you need to focus on building wealth first. Pay yourself first. Make saving and investing your first priority before splurging on anything else. Commit to setting aside a percentage of your income for savings and investments before you spend on anything, including luxury items. Automating your savings ensures that your financial goals remain your top priority. Set asset goals before luxuries. For every luxury purchase you desire, set a financial milestone first. Want that luxurious car? Focus on building an investment portfolio or passive income streams that could cover that cost comfortably without sacrificing other areas of your financial life. Redefine luxury. Shift your perspective on luxury. True luxury is financial freedom, peace of mind, and a future where your wealth works for you. A $1,000 investment today could bring you far more lasting happiness and security than a fleeting indulgence like an expensive car. Real-life Singapore story. Elaine's smart move. Elaine, a marketing professional in Singapore, had been eyeing a luxury car for months. She saved aggressively, cutting back on other expenses to afford it. But just as she was about to make the purchase, Elaine stopped to reassess her financial goals. She realized that the car would give her temporary happiness, but wouldn't align with her long-term vision of financial security. Elaine decided to take that money and invest it instead. She bought stocks and ETFs, which started generating passive income. A year later, her investments had grown, and she had built up an emergency fund, providing peace of mind. Eventually, Elaine was able to purchase her dream car, using the returns from her investments. The key takeaway? By delaying gratification, she was able to enjoy her luxury car without compromising her financial stability. The key takeaway: buying luxuries like a car isn't inherently wrong. It's all about timing. Build assets first. Let those assets generate income, and then use that passive income to fund your luxury purchases. This strategy not only protects your wealth, but ensures that your lifestyle upgrades are sustainable. What luxury car have you been dreaming of? What's one financial goal you can work towards before splurging? Let us know in the comments, and remember to like this video and subscribe to Wealth for You for more tips on building your wealth without sacrificing the things you love. Wealth Killer 3. Falling for get-rich-quick schemes. We all dream of striking it rich overnight. Who wouldn't want a life of financial freedom without all the hard work? But here's the reality. Get-rich-quick schemes often promise massive returns with minimal effort, and they can lead you down a dangerous path. Whether it's buying into the next meme stock craze, putting your money into unregulated crypto, or signing up for expensive online courses that promise overnight wealth. These shortcuts can be more of a financial pitfall than a golden opportunity. Examples of get-rich-quick schemes. Meme stocks. These are stocks that gain sudden popularity due to social media hype rather than company fundamentals. GameStop and AMC are prime examples where thousands of people bought shares on a whim, driven by online forums, only to see the stock prices crash. While some made quick gains, many others lost big. Cryptocurrency scams. Crypto promises huge returns, but it's also rife with fraud. Scams like pump and dump schemes, where early investors hype up a coin to sell at a high price, leave late investors holding worthless tokens. Plus, unregulated exchanges can easily disappear with your funds. Forex trading. The forex market can be volatile, and many people fall for promises of large returns with minimal risk. However, Forex trading requires significant knowledge and experience. Many new traders end up losing money, especially when they follow misleading get-rich-quick advice from untrustworthy sources. Overpriced online courses and secret investment tips. Some marketers promise they can teach you how to build wealth in minutes with an online course or exclusive investment tip. These courses often focus on one-off strategies that sound too good to be true, but they fail to deliver the promised results, leaving you with little more than a lighter wallet. How to avoid these schemes. Instead of chasing fast returns, focus on strategies that are proven and require patience. Here's what you can do. Educate yourself. Understand how investing works, what your risk tolerance is, and which investment strategies have a history of long-term success. Stick to proven strategies. Consider investing in index funds, ETFs, and dividend-paying stocks. These may not offer the thrill of quick wins, but they provide steady, reliable growth over time. Avoid high-risk opportunities. If an investment sounds too good to be true, it probably is. Be cautious about investing in anything that lacks transparency or has unclear risks. Real-life U.S. story. Jessica's wake-up call. Jessica, a young professional from New York, was excited when she heard about the explosive gains made by early investors in cryptocurrency. She quickly threw $30,000 into a crypto scheme that promised massive returns, only to see her investment disappear in a scam. Instead of giving up on investing altogether, Jessica took the opportunity to educate herself. She enrolled in free online courses about personal finance and learned about safer investment options like index funds and dollar-cost averaging. Within a year, she rebuilt her portfolio, and today she's seeing steady growth with proven strategies. Jessica's story shows that while it's tempting to chase quick gains, building wealth is a slow and steady journey. Real-life Singapore story. Arjun's lesson. Arjun, a young professional in Singapore, was excited when he was introduced to a Forex trading scheme promising huge returns with minimal effort. He invested $20,000, hoping for quick profits, but instead, he watched his money evaporate as the market turned against him. Instead of becoming discouraged, Arjun attended a financial literacy workshop where he learned about safer financial strategies, including making voluntary CPF top-ups. He put the money he would have risked in Forex into his CPF account, which grew tax-free, providing him with a stable long-term saving strategy. Today, Arjun enjoys the peace of mind knowing his money is growing in a secure and reliable manner. The key takeaway: chasing get-rich-quick schemes can lead to heartache and financial setbacks. The key to building lasting wealth is education, patience, and focusing on proven strategies. Remember, the path to financial success isn't about instant gratification. It's about steady, consistent growth. Have you ever fallen for a get-rich-quick scheme? What lessons did you learn from that experience? Share your story in the comments below. Conclusion. Which one of these wealth killers do you think you'll tackle first? Drop your answer in the comments below. Building wealth isn't about making huge sacrifices. It's about making small, smart choices and consistently avoiding these common wealth killers. If you found this video valuable, don't forget to hit that like button and subscribe to Wealth for You. The best investment you can make is in yourself, and we're here to help you do just that. Let's keep growing together. See you in the next video. Let's break the cycle of wealth killers together. Subscribe now, and let's build your financial future.